My name is Sean van den Berg. I head up client education at PSG Online. Welcome to our webinar on understanding fundamental analysis. Here's my agenda for today, or the topics we could discuss. Got a lot to cover today. So any questions we have, just type them up in the question box. And then as we go along, I'll try and answer those questions that's context related. Secondly, obviously this presentation is being recorded. For those of you that are attending this webinar will be getting the actual PowerPoint presentation, link to the presentation, as well as the recording tomorrow. The idea there is for you to review the presentation. Any other questions you have, please, you're welcome to send it through to me, and I'll answer it as such. Here's the agenda today. We're going to discuss fundamental analysis. Obviously, there's two parts to it, what we call macro fundamentals. We're going to spend most of today's session on micro fundamentals, so it's reading financial statements. Most importantly, we're going to spend a lot of time on understanding financial ratios, then looking at valuations, the three ways of looking at a company from a value point of view, and then also just to highlight the tools available to you on the PSG Online website to help you make a better informed decision. So that is the topics we're going to discuss. Let's get going. To make money on the stock market, there's three questions you need to ask yourself. You need to know, what must I buy, when must I buy, and when must I sell? If you can answer those three questions, you'll be making money in the market. So what we do is we cloud it a bit more and make it a bit more complicated. We give it a name called fundamental analysis and technical analysis. Those are the two approaches. We analyze shares in the market. So fundamental analysis asks a question, what must I buy? How good will this company be as a generator of future profits or earnings? How good will this company be as a generator of future dividends? So that's what we're going to concentrate on today, is asking that question, what must I buy? So you can see by this diagram here, fundamental analysis is broken further into what we call macro fundamentals. That's looking at the bigger picture and all the things that can affect the company. For example, from an economic point of view, what are the things that can affect the company? And it's about 5 or 6 things we're looking at. When we talk about micro fundamentals, now we're talking about the company specifically, but more specifically the financial statements, looking at the balance sheet, the income statement, the cash flow statement. We go one step further. We look at various financial ratios to help us determine, has there been growth compared to the previous report or previous 6 months, and also what is the health of the company. So as I say, that's what we're going to concentrate on today. Obviously, the other side of the spectrum is what we call technical analysis. This is where we start looking at charts. With fundamental analysis, obviously a lot of factors involved. Technical analysis, only 2 things we look at, price and volume. But obviously we're not going to focus on that today. There's other webinars for that. Okay, so let's get into quickly on macro fundamentals. Just to give you a heads up, I suggest that you guys refer to the online tutorials, goes into more detail. So this presentation is built on the tutorials. So before logging in, you'll find there's a button called resources. So you click on that and then open up the resources page, and then look for the tutorials, and then the tutorials 3 and 4 will be referring to the stuff we'll be talking about today. Okay, so that's additional information that you can go through and learn about the theory as such. Okay, so let's talk about economic analysis or macroeconomics, macro fundamentals. Okay, just as I say, any questions you guys have, just send them through. The line's not clear. That's from Tracy. Anybody else having a problem with sound? Okay, JP, yes, this presentation is being recorded. I can send it through to you, and that's the same question from Derek Bester. Is anybody else having a problem with sound? Likewise, not clear. Yes, the line is bad. Echo on the line. Okay. Sure. No problems, all good. That's from Alex. I'm getting mixed signals here. Line is breaking up a bit. Yes, poor audio. Yep, but unclear. Guys, I'm sorry about the sound. Maybe will get a bit better. Okay, guys, so I'm sorry, I didn't know how to fix this up. I hope you guys can hear me clearly now, and the echo's gone. So this presentation is being recorded, so hopefully it'll sort itself out. Okay, so when we're talking about economic analysis, there's 5 things that we're looking at. The public enemy number 1 is inflation. So the Reserve Bank Governor or the Monetary Policy Committee meeting as a target to keep inflation under control. So we're talking about inflation between 3 and 6%. We're at the top end of that target at the moment. And obviously our biggest import is oil. And with the rand weak at the moment, obviously it's not good for inflation. So we can anticipate interest rates so inflation to go up. Obviously there's pressure for prices to go up. And the Reserve Bank Governor and the Monetary Policy Committee meeting, MPC, they use interest rates as a mechanism to control that. So you have to ask yourself the question, is interest rates going up or down? At this point in time, we're at 30-year lows. There's more pressure for interest rates to go up, but we're only anticipating that next year. GDP is the amount of goods and services being produced in the economy. Above 4%, we say there's growth. It's patchy at this point in time, so it's not there yet, and that's why we're keeping interest rates low. Exchange rates weakening or strengthening. At this point in time, we're hovering around just under 10 rand to the dollar. Obviously, the exporters would benefit from a weaker rand, but as I say, obviously our biggest import is oil. So at this point in time, the trend is more rand weakness, and that's got a lot to do with the dollar strength. And that's also got to do with interest rates in the States with at very low levels. But there's also pressure for interest rates to go up. As interest rates go up, you find more funds being repatriated back to the States. So at this point in time, we have this what they call carry trade. The rand is relatively strong or stable because of funds coming into South Africa to take advantage of our higher interest rates. But I think the best way to look at this is to look at it at the table. The relationship with all those 5 factors with the stock market. So if I bring in my cursor in here, my spotlight, the relationship with all those 5 factors with the stock market is like a seesaw. If the market's above average, you find that interest rates have been declining because of low interest, because of low inflation, because of below average economy. They're trying to stimulate the economy. You find that obviously funds were coming into South Africa because of declining interest rates. Otherwise, if we find that inflation starts going up, interest rates start increasing, the economy is becoming overheated, there's funds, the rand is weakening and such. So this is that interrelationship. Just think of a seesaw. As interest rates go down, market goes up, and vice versa. Okay, so you can look at that interrelationship with the investment cycle. And this is your objective as an investor, to position yourself to take advantage of the GDP or the interest rates and things like that. So here we go. This dotted line is the stock market. You can see we still over here somewhere. We're still growing a lot. GDP, we're still way below that 4% average, and interest rates are bottoming out. So you have to ask yourself, where are we on the different phases as such? I presume, or assume we're around about here still. Anticipate interest rates to go up, as I say, from next year onwards. GDP growth will start picking up, hopefully, but obviously the stock market will be coming off. Okay. So this is a very quick heads up to macro fundamentals. I want to focus mainly on the micro fundamentals, financial statements and things like that. So here we're talking about the income statement, the balance sheet, and the cash flow statement. Okay. Here's a very simplified income statement. Way to explain the income statement, imagine it's the movie of the company's operations over the last 12 months. So you can see this is until the end of September. Obviously, there'll be 2 columns, compare one year to another year, 1 year to the previous period. But this is a very simplified version of showing you the format of the income statement. So very top line, you'll get what they call sales or turnover or revenue. And then we'll have the second line item. Sometimes they disclose it, sometimes they don't. Obviously, cost of sales or lesser expenses. Then we get what they call operating profit. Or they call it nowadays earnings before interest, tax, depreciation, and amortization. Okay. Then I have a very important line item here called less finance charges. If you got any borrowings, this will be less your interest charges or finance costs. That has to be declared as a separate line item. And then we have what I call profit before taxation or earnings before tax. Then very importantly, we have a very important line here called taxation. So we need to know what we're paying in taxes. Company tax now is about 28-29%. So you want to be close to that area as possible. You want to be paying too little tax because obviously the receiver wants his share. So going forward, you can anticipate that you'll have lower profits because of the higher tax. You want to be paying, it's okay paying too much tax because obviously going forward, that line should be coming down. It means you'll have more profits. Anyway, we have a line item after that called profits after taxation. And then we have a thing called less preference dividends. So it depends on the company structure. When the company first was set up, you might have had preference shareholders. The difference between a preference shareholder and an ordinary shareholder is that preference shareholders get paid their dividends first before ordinary shareholder. That's the main difference. So depending on the capital structure, you'll have preference shareholders being paid before ordinary shareholders. So then we have what we call earnings or net profit. Then we have our ordinary dividends owed to ordinary shareholders. And then what's left behind after dividends being paid out to ordinary shareholders is what they call retained earnings. And this is a source of capital that the company can use for growth going forward, either to expand their business or to get rid of debt. But the source of capital, you can go to the banks and borrow money from the banks. You can issue more shares and raise capital from shareholders. But this is another way of having access to capital is retained earnings. Okay, but from this income statement, we can pick up a lot of financial ratios. We discussed that just now, and this will help you determine is the company growing. Okay. The second item, second balance sheet, second financial statement we want to look at is what we call the balance sheet. This is a very, very simplified one. As the word implies, it has the balance. You've got assets minus liabilities equals net assets. That's on the one side of the equation. The other side of the equation is shareholders' funds, or they also call it capital employed. Where did the funds come from, and what was it spent on? That was the balance sheet basically looks at. So we talk about assets, we talk about buildings, we talk about machinery, we talk about stock, we talk about a plant, whatever the case might be, whatever the company uses to produce goods and services. Okay, less our liabilities. This would be short-term and long-term debt. This is going to be borrowings. Bottom line, it has to balance. You've got 150 million rand, and it has to be equal to 150 rand on the other side. Where did the funds come from, and what was it spent on? Okay, this is how we start looking at the health of the company. Okay. And you can also see is the company's assets growing with looking at net assets value and things like that. And the third financial statement we want to look at is what we call the cash flow statement. There's three parts to it. The most important part that we like to look at is what we call cash flow from operating activities. So this helps you start looking at the financial health of the company also. So in this situation, we've got operating profit before tax, depreciation and modernization, all these provisions being made for. Okay. Bottom line, we've got this thing here called net cash provided by operating activities. In this situation, 58 million compared to the previous year, 44 million. But you want to take this number now in millions and break it down to a per share value. That's ultimately what you're trying to do. But before you can do that, you want to look at sustainable operations. So usually we would subtract capital expenditure, what they call CAPEX, from that amount. But usually it's not disclosed and not readily available. So we subtract the depreciation number. That 14 million there from depreciation to get a more sustainable view of the company. So that's what we were talking about just now, that 58 million, less our 14 million depreciation. So we have an adjusted cash provided by operating activities of 44 million. Divided by the number of shares in issue, we get a cash flow per share value. In this situation, 5.18. Okay, compare that number now to the current earnings per share. We'll talk about earnings per share just now. This helps us calculate a ratio, the cash flow divided by the earnings per share. In this situation, 0.69 compared to the previous year, 0.5. So that we can see there's improvement, there's growth, but bottom line, anything that's above 0.75 would be considered very, very good. In other words, you're converting your cash into profits. That's what we're looking at here. So it's one of the ratios that you look at that helps us look at financial risk. If any financial ratio is consistently below 50 or 0.5, a little red flag must be raised. Something's wrong here. Okay, they're not converting its profits into cash. Okay, so we'll talk about interest cover just now, but also cash flow is very important. Those are the two most important things to look at, I think, from a cash flow point of view, from a risk point of view. Okay, so let's talk about ratio analysis. Okay, there are various financial ratios that you can use. It's better now. It seems better. Okay, so it looks like the sound is better. Great. Okay, keep those questions coming through. I'll tackle them just now as we go along. Okay. But I hope you guys are enjoying this anyway. Sorry, let's move back to my little cursor here. There are various financial ratios that you can create or use to help you determine the health of the company and also the growth. I'm just going to highlight 5 or 6 of them just to help you get started choosing shares from a fundamental point of view. Okay, so if I had to use a magic wand, I always say if I had a magic wand, what kind of shares would I like to invest in from a fundamental point of view? There's 3 broad categories I like to look at. I like to buy into companies that are undervalued, and in the sense that there's upside potential. I want to buy into companies that are profitable, and also I like to buy into companies that have manageable risk. So those are the 3 broad categories. If you look at undervalued, oops, let me just go back. Let's go back quickly. There's 3 benchmarks and such. The market at the moment, when I say the market, that's the JC All Share, is an average about 18.5 on the PE, and I'll discuss these financial ratios now. Ideally, I like to look at shares that are undervalued based on a PEG. So anything below 75 would be classified undervalued, and based on a price NAV ratio, anything below 2 would be classified as undervalued. This is how I'll explain all these financial ratios now. When we start looking at profitability, I'm looking for companies that has a return on equity greater than 15%. Remember, the main thing I'm looking at here is sustainability. Can I sustain this kind of growth? And when I start looking at risk management, I'm looking for interest cover greater than 3 times. Okay, so let's talk about these financial ratios. We spoke just now about profit, but another word for profit is earnings. So we spoke about just now about retained earnings. Usually about 2/3 of the company's profit or earnings gets reinvested back into the business for future expansion, future growth. But only about 1/3 gets paid out in the form of dividends. And that's depending on the company's dividend policy. That's decided by the company's directors. But now that profit, okay, if you look at the little number over here, the profit or earnings divided by the number of shares in issue, we get what we call an earnings per share. Now that's useful because now I can compare one number to another number, one company to another number, because it's a per share value. In our example here, we had 66 million rand in profit or earnings, and we had 825 million shares in issue. So the earnings per share in this example is 8 cents per share. I can take that number now, compare it to current share price to see if it's cheap or expensive. And there's 2 numbers that we use. Number one, we have what we call earnings per share divided by the current share price, and this is what we call the earnings yield as a percentage. Okay. When you open the share price page in the newspaper, you'll see all those different columns, that EY, that's what we're talking about. You can just compare it to the return in the savings account. In this example, our earnings yield, earnings per share was 8 cents per share, and the current share price is 1 rand or 100 cents. Okay, so in this scenario, our earnings yield is 8%. So you want to compare that to the return you can get in the banks. The banks are giving you about say for example, giving you about 5%. This will be a better investment because giving you a higher return. So when you look at earnings yield, you want a higher earnings yield. Now the reciprocal or the inverse of that is what we call a price earnings multiple or price earnings ratio. So same scenario now, the current share price divided by the earnings per share. In our example, 1 rand divided by the 8 cents, we have a PE ratio or PE multiple of 12.5 times. So what would you prefer? Take 10 years to recover your money out the market or 12.5 years to recover your money out the market? Hopefully 10, you're going to have a lower PE ratio. So it's just the opposite of an earnings yield. Okay, you want a low price earnings multiple. The other thing we'd like to look at is what you call dividends per share. Very similar to earnings per share calculations. Dividends divided by the current share price. As I say, it's roughly about 1/3 gets paid out. Then out of 8 cents, only 3 cents has been paid out in the form of dividends. So in this scenario, our dividend yield is 3%. Remember, dividends are now taxed. You're being taxed 15% on your dividends. But obviously, that is taken consideration afterwards. Okay. So this is looking at, give you a bit of perspective where the market is right now. This is the JC All Share, all the shares in the market. You can see how we've been performing. Let me bring back my little spotlight here. This is until Monday's graph, so we're very close to all-time highs. So people always ask, is the market cheap or expensive at this point in time? When you start looking at the PE ratio, you can see historically we are now trading in expensive territory. Where we're trading around about 8 on the PE, we're cheap, but now around about 19, we're expensive. Okay, so the inverse of that would be called the earnings yield. We're trading at 5, whereas at 13, we're quite cheap. Okay, and here's dividend yield. We're trading around about 2.8. So between 2.5% to 3%. That's the average of the market. We've been as high as 5. Okay, sorry, I have to go back there. So that gives you an idea of the whole market. You want to compare the share that you're looking at relative to the market. Okay, so that's one way of valuing the company, called it what they call a PE ratio. We consider that one of the old methods of looking at it because obviously it does get distorted. Companies do issue more shares or they buy back their shares. You want to compare one share to another share if the financial year ends. You want to compare the same shares in the same sector. So we prefer at PSG Online to use a thing called a PEG ratio, and I'll explain that now to you. The PEG ratio is fast becoming the most frequently used valuation technique. All it is the PE ratio divided by the forecast average growth over the next 5 years. Now, before you start your eyes glazing over, you think, wow, where am I going to get these numbers from? Just remember, PSG does this number crunching for you. But basically what this PEG ratio does, you're not only looking for companies on a low PE ratio, you're also looking for companies that has a PE ratio that's low relative to the earnings growth. And you'll see on the next slide what I mean by that. So you're targeting the better companies trading on the low PEs. When I say better companies, these are companies that are growth companies. Those are the companies you're looking for. So as long as the earnings growth is higher than the PE ratio at the time of investing, those are the kind of companies you'd like to invest in. There are disadvantages, however. Companies that are volatile with their earnings, obviously you'll have some distorted numbers there. Or companies that have declining profitability, in other words, if they have negative growth, obviously this is not applied to them. And companies that have very low growth rates will not be very applicable to the PEG ratio. Okay, so obviously the gold mining shares are very volatile in their earnings, so these things are not, the PEG ratio is not very applicable to them. The same thing with the property companies. End of the day, property companies are rental income, so PEG ratios don't really apply to them. Okay, but here's an example. You've got two companies both trading on a PE 15. Which one are you going to go for? Most people will go look at the share price now, and I can give you a word of advice: never buy a share on price, buy it on value. So now we start looking at the PE ratio, but the relationship with the growth. Now, stock 1 is growing its earnings by 30%, whereas stock 2 is growing its earnings by 10%. So how's the PEG calculated? All you're doing is dividing the PE, the 15, by the growth, and that's how we get a PEG ratio of 50%. Now, 50% is considered very, very cheap, okay, undervalued, whereas a company trading on a PEG of 150 is considered very expensive, okay. So you might consider you're looking at stock 1, although it has the same PE, but its growth is much higher. Okay. The sector as such, 75 will still be considered that it's valued, there's value there as such. Okay. So a company trading on a PE of 30 and a growth rate of 30 divided by 30 as a percentage will have a PEG ratio of 1 or 100. And we consider that as fair value. Okay, that's a trade-off between cost and growth. On our website, we color-coded for you guys. Okay, it's very simplified. You want to go buy the shares that are trading at a discount or trading at what we call margin of safety. So between 35 and 75 on a PEG ratio, those are the kind of companies you want to look for. Most of the market right now will be considered fairly valued, and you'll see an example just now where the fair value is in the yellow range. but you want to avoid the shares that are in the red. Those are companies very overvalued. And there are quite a few companies that are overvalued just now, and I'll mention some examples just now. But here's an example. Most people will go for an IT company over a beer company. This company is forecasting its growth of growing about 20%. They have a PE ratio of 50. People are willing to pay up a higher price. But you can look at the PEG ratio, 250 or 2.5. It'll be very, very expensive. Okay, we'll consider that overvalued. Whereas the beer company is growing at a much lower rate. Okay. Gee whiz, because I'm having quite a few technical problems here with sound. Hope you guys can hear me clearly. Sound is very poor. Yeah. Murphy's Law. We'll see how this goes. Okay. But big ratio is the ratio we prefer to use. Another one we like to use is what we call net asset value, or price compared to net asset value. All it is the ordinary shareholders' funds divided by the total number of shares in issue. Okay. In theory, if the company had to go into liquidation, we sell off all our assets and pay off all our debts. What's left behind for distribution is what we call NAV. Okay. So let's say, example, we've got 276 million rand in shareholders' funds, 850 million shares in issue. If the company had to go into liquidation, the net asset value for this particular company is 32.4 cents per share. Compare that now to its current share price, and that's what we call price NAV. And ideally, a company should hardly ever trade below NAV. But those are the companies you should be looking for. Companies with a low PE ratio usually do outperform the averages of the market. So it's another way together with a PEG ratio to look for undervalued shares. So in this situation, the share price is trading at 1 Rand. Our PEG is, NAV is 32.4 cents. Our price NAV is trading 3.1 times higher than NAV. So obviously people are willing to pay a higher price for that. So one way to calculate is it overvalued or undervalued is to combine it with what we call return on equity. So the higher return on equity with the price NAV, that will be justified. If it's have a low price low return on equity, then the price is not justified. Okay, so let's talk about profitability or return on equity. There's two ways to calculate it. Profit owed to shareholders divided by all the shareholders' funds. 66 million divided by 276 million in issue. In this situation, our return on equity is 23.9. Remember, our benchmark is 15% plus. Does it meet our criteria? Yes. So you can tick the box there. Another way of looking at it is the earnings per share. So obviously you have to do a bit of a calculation there. And also look at the opening net asset value, which would be the closing net asset value from the previous report. So in this situation, 7.4 divided by 28.8, we have a 25.6 return on equity, which is very close to our previous calculation. So there's two ways to look at it. You get in that ballpark. But again, more than 50%, doesn't meet my criteria. Yes, the company is profitable. Okay. Then we start looking at risk. The old way of looking at risk was what we call debt equity ratio. So it's our long-term and short-term interest-bearing debt, less our cash in the tills, less our deposits in the banks, divided by the shareholders' funds. Bottom line, we've got a situation of 144 million rand in borrowings and shareholders' funds of 288. We've got a debt equity ratio of 50-50. Is it good or bad? It's very, very good compared to a situation where you're buying a property. You buy a property now, put down 10%, you borrow the other 90%. Debt equity ratios, debt is 90%, equity is 10%. Who owns the property? The bank. Okay. In this situation, with debt equity 50-50, you can negotiate with the bank better interest and things like that, better service, etc. We prefer to go one step further. We like what they call interest cover. Okay, we want to see, is that debt manageable? So here we're talking about earnings before interest and tax. Okay, divided by the net interest paid. So you might have interest received and interest being paid out. This is a net scenario. So our earnings divided by our interest bill in this situation, the 115 divided by the 20, our interest cover is 5.75. So this was a large cap stock. We say, great, this is manageable, but ideally we're looking for 3 times cover. For small cap stock, you're looking 5 times cover. Okay. Less than 3 times cover or less than 5 times cover, that's risky. I'd rather walk away and look at other investments. This, together with the cash flow ratio we calculated earlier, these are 2 very important ratios you want to look at from calculating risk. Okay. So others is all combined to the research available on our website. Okay. There's 3 things I want to highlight for you guys. First of all, it's what we call company analysis. So once you've logged in with your username and password, go click on share info, enter the share code. So for example, you might be interested in Mr. Price. Okay. Once you've loaded up Mr. Price information, there's a lot of information all on one page related to Mr. Price. That's a big time saver. But there's a little tab here called research. Click on that research tab, and you'll find there's a little link here called company analysis. Now, company analysis takes you through to a research done by IFR, the company that worked with us. They're independent of PSG Online. But they take the same information you read in the newspaper, and they write up a bit of a report on it. So this is obviously now done on the 22nd of October, a week or so ago. They came out of a trading update, increasing their earnings between 20 and 30%, from between 20 and 24%. However, our recommendation was a sell. Why? You'll see this now when we start looking at the various financial ratios. But this is what's important, is looking at, they take all those numbers, they put into a little table like this. So here's Mr. Price. Now, the reason why we gave a sell recommendation on Mr. Price is because it's expensive. Okay, historical PE is 20.2, where the average of the market is 18.5. But you've got to also see the price NAV. The price is 9.5 times higher than its NAV of 10 Rand. It's trading at 128 Rand. So really, there you can see there's 2 scenarios where it's expensive. And third scenario is the PEG ratio. Remember I said anything between above 126 plus will be considered overvalued. That is why we're giving it a sell recommendation. It is expensive. So obviously it had a good run, but I won't rush out and go buy it and we'll invest in it right now. As a trader, you might want to speculate on it, but from an investment point of view, it's overvalued. Yes, it's meeting all the other criteria, profitability, things like that, interest cover, return on equity. It's a great, it's a very profitable company. Cash flow is still there, but value is not there. Okay. You'll see some other examples just now where we combined it all together, 4 different companies. At Mr. Price, you can see where they were trading at all-time highs. We're very close to expensive territory. Yes, we've got some upside potential, but I wouldn't rush out and buy it. You know, there has to be some profit taking soon. You can see that on an earnings yield, it's 4, and on the 2 dividend yield. So yeah, they're not cheap right now. Here's another example, a bank. This is First Rand. Obviously, banks have other financial ratios. I'm not going to go into too much detail now. We'll have to have another webinar on financial, analyzing financial shares. You can see 11.9. You see the PE ratios, the PEG ratio obviously much lower. The price NAV is still much lower. You can see compared to Mr. Price, it's still cheap. However, we're also still making new highs. But that's the market. The market is making new highs right now. That gives you a bit of perspective of what's happening with banking shares. And this is like a proxy for all the banks. That's looking at a resource company, BHP Billiton. Now, BHP Billiton is slightly cheaper on the price NAV, 2.2. You see historical PE, 13. And you can see also the PEG ratio is much lower. Okay. But they're not cheap. Okay. Here's the graph. You can see also moving sideways. We're trading quite close to our historical highs. Obviously not as high as previously, so there might be still more upside potential. Okay. So that's Billiton. There's Lewis. Now, Lewis is one of the companies that are one of the few companies that's trading in an undervalued territory. Obviously, there's a lot of sellers dropping the company, thinking that this company is in the same boat as African Bank and everybody else. But I like Lewis. You can see it's quite cheap on historical PE, 5.8. We do have this in our long-term portfolio. Price NAV, trading at this point in time, this was in March, they're trading at a 10% premium to NAV. But also look at the PEG ratio. So these guys are still very cheap. You can see they have bounced up recently, but they're still very, very cheap on the PE ratio. I believe there's more upside potential of a company like Lewis. You see, also what I like about Lewis, by the way, they've got a very attractive dividend yield. We're talking about more than close on 7% dividend yield. Okay, so that's where the opportunities are by looking at companies that are undervalued as based on PEG ratio and based on price NAV. Okay, so a quick summary, looking at the big picture, obviously the economy is important. We want to see the economy growing, but also inflation and interest rates. Those are the two things that you want to keep an eye on, especially when you're reading the financial press. We're talking about earnings growth and turnover growth being more than 10%, has been conservative. Profitability, return on equity more than 15%, interest cover above 3 times cover, cash more than 0.75, and then obviously valuation, PEG ratio, and price NAV. Those are some benchmarks you can use to help you choose shares from a fundamental point of view. Okay, on our website, there's tools that help you scan the market to look for undervalued stocks. So let's have an example. We spoke about Mr. Price just now. You can go click on research and go click on filters and go select the sector, general retailers, because that's where Mr. Price falls in. There's Mr. Price. Okay. You see, as I say, they're overvalued right now. This is on the PEG ratio. You can see all the other companies basically in the same boat. The only company that's really cheap in that sector is Lewis Group. We spoke about it just now. What I suggest you go one step further is to click on research and then click on the search button. And there's shortcuts here called undervalued. There's investing for dividends, investing for growth. Okay. As I said, there's not much value in the market right now. Out of the whole market, 400 companies, there's only about 6 companies that are classified as undervalued right now. By the way, you can click on this little explanation here. We'll explain a bit more how we use these financial ratios as such. But Amacor, Eltron, Lewis Group, Northam, Peregrine, and Transpaco are the only 5 or 6 companies that we consider as undervalued right now based on the PEG ratio. You can go one step further and click on the tab there called quality. So there's quality tab, those 5 or 6 companies now. Those companies are still undervalued and they are quality companies. When we say quality, they are consistent in the earnings. They're not volatile in the earnings. So all of them above our criteria of 75, sorry, on 70 on the quality rating. So there's the two things we combine together. Okay. So use those tools to help you find shares to add on to the watch list. Now, the idea of the watch list is, yeah, I've created a watch list of shares that I like to look at. Obviously, the watch list, this is updated as the prices trade, 50-minute delayed, or if you're on live prices, these do update as they happen. So it highlights for you where there's activity. I like to have 3 different watch lists, maybe one for financials, one for industrial, one for mining and resources, but it highlights opportunities for you. But more importantly, I find it's a big helpful tool by clicking on a little button here called View as Investor. But now it changes your watch list now to a value investor. And from there you can click on the different columns, and from there you can obviously find better opportunities. So for example, if you click on the column for PEG, my watch list now, for example, only African Bank, Lewis and African Bank are the 2 shares that are undervalued right now. You can see a lot of these shares are overvalued. There we got Woolies, I got Massmart, and obviously Richemont that are expensive. Obviously Richemont is a special case. Remember, these guys have operations offshore. They operate in an interest rate environment much lower than us. So just be careful by writing them off and say they're expensive. There's a lot of other things you have to look at. Okay, but Woolies and Massmart are definitely expensive. We're talking about a 21 and a 31 PE, where they're growing their earnings by 13, growing the earnings by 13 as such. Okay, that's a useful tool to help you look for shares. Okay, so just quickly before we start tackling any questions, I know we've got a lot of questions coming through. It's important to understand that PH Online adjusts all those figures you saw just now for sustainable growth. So we ignore any companies that we only look at continuing operations, and obviously look at companies that have growing operating margins. So this is what we're looking for when we look at those numbers. The idea of the watch list is an important tool to use. As I suggest, create 3 different watch lists. I suggest maybe mid caps, small caps, or mining, financials. Split them up. It's a tool to help you highlight opportunities. I'll look at it that way. And then obviously value investor or value filter, scan, use the defaults. There are 3 different scans you can use. And the end of November, we're going to more detail how to use the different approaches to the market, the 3 different strategies. So this is what it's all based on. Okay. So before handling any questions, I'm going to highlight the Traders Forums meetings coming up. We've got 2 left for the year. End of November, I've got our last one for Joburg. That's the 26th of November. Remember, the Traders Forum is where we actually get face-to-face in a room, and we discuss the market in general, what's happening in the market, and ideas to look for trading opportunities, but also to highlight investment opportunities. So we discuss the market in more general detail, more general terms as such. And then I have my last meeting for Cape Town on Tuesday the 10th of December. So those of you in Cape Town, there's still lots of space available. Please go online and book a seat. Okay. Then we've got our last 3 webinars for the year. 2 weeks' time, we got a webinar on Japanese candlesticks. Those of you that are more technically orientated or trading, Japanese candlesticks is one of the most popular webinars we've had this year. This is our first review since I think it was February. We did it last. So we'll be discussing Japanese candlesticks. And then following on from this presentation, on the 27th of November, we'll be discussing more the investment strategies. So we discuss in more detail value investing, growth investing, and investing for dividends. Then our last webinar for the year will be another technical analysis session, looking at another price chart similar to Japanese candlesticks. I like to call it the forgotten art of point-and-figure charts. This is Norton-figure charts. This is great for the more intermediate trader. I use it a lot. I love point-and-figure charts. They're the very first charts I ever used. Okay. So guys, before we tackle any questions, as I say, the presentation will be sent to you guys, hopefully by tomorrow, if not by Monday the latest. But you'll begin the presentation, and hopefully with a recording that came through fine. But please use the research tools available on the website. Those of you that haven't got accounts with us yet, please maybe use the free trial option. Test us out, see what we like. You'll have access to those research tools. So remember, the share info is a nice way to have exposure to the share with all the information related to the company, but more specifically the company analysis. Use the search function. Look for shares that are undervalued, but also that are quality. And then obviously, ultimately, you want to create watch lists. And as I say, refer to the online tutorials for more information. We do have a weekly or bi-monthly newsletter called The Investor. We discuss one particular stock, more for the long-term invest, but using these financial ratios. As I say, watch out for our upcoming Traders Forum and our webinars coming up. Okay, let's see what questions we have coming through from you guys. As I don't answer any of these questions now, I'll be, sorry, let me just get rid of this little cursor thing again. I'll be answering it through the emails and things like that. Let's go right to the top. Quite a few emails coming through. Wow, you guys have got a lot of emails. Webinar being recorded. Yes, I've mentioned that already. Yes, recorded. There's a question from how will it apply fundamentals for selling stocks using the PEG? Selling stocks, obviously exactly the opposite we saw just now. Undervalued, you want to sell stocks that are overvalued. You saw my example with Mr. Price. You'll sell stocks when they're overvalued by using fundamentals. Let me look for more information, more questions. Questions, we found it up. Better now. Okay, here's a good little question here from, who's this from? Andres Kruger. Just repeat his question here. Would it be accurate to say fundamental analysis is more accurate, is more for investors, whereas technicals is for traders? I agree with you wholeheartedly. But saying that, my background as such, I am a technical analyst, but over the years I've learned fundamentals is important. Let me explain, give you a little bit of analogy. You can sit in a canoe with one oar, just using one approach, for example, fundamental analysis. What's going to happen if you use one oar? You're going to go in circles. So I prefer to use both approaches, fundamentals and the technicals. So yes, I'm asking myself more questions, fundamental questions and technical questions. That means I'm doing more homework. The more research you do, the more prepared you are. I believe that you'll be more informed, hopefully make a better decision, and ultimately make more money. I find that combining the two approaches is great for being more of the long-term investment approach, but even as a short-term trader, it's important to have a bit of understanding of the fundamentals. You need to know what sector you're involved in. You need to know what factors are going to affect the share. Also, from a trading point of view, especially when you start looking at CFDs and single stock futures, it's important to understand when will those companies' results be issued, what will the expectations be, will it be positive or negative, because those things will sway the share price in the short term. But Andres, to answer your question, yes, fundamentals are more for the investors, but I prefer to use both approaches. But great question. Thank you very much. Okay, so it looked like there was a bit of a delay with the slides. My apologies. Clear to me. So I'm getting mixed feedback regarding the sound and mixed bag regarding the sound, the slides. How many undervalued big stocks is available on a monthly basis on the JSE? This is a question from JP. It's not available. It's just what's happening right now. Remember, it's the price, okay, relative to the PEG ratio. So obviously, as the share price moves up and down, the valuation changes. So right now, obviously the market has had a good run. You find that a lot of those shares have become overvalued. Some of them are obviously, most of them are still fairly valued. And you saw just now, that was the 5 or 6 shares that are available right now that are undervalued. So there's not much value in the market right now, JP, to answer your question. And obviously that changes. You know, if we have a nice little healthy correction, a lot of people take their profits out of the market right now. Market pulls back 10%. You'll find that list will get much bigger, that list of undervalued shares. But right now, there's not much value. How do we do, this is a question from Eleanor, how do you evaluate banks with regards to these fundamentals? You still use the PEG ratio and things like that, and the price NAV. The biggest thing with the banks, we don't use the interest cover, because obviously the criteria for them is slightly different. They have to have a certain amount of capital available, and you saw just now on the slide of First Strand, there's a lot of other financial ratios you'll be looking at, expense ratio and things like that. Again, I'll suggest that you go look up on the website, on the tutorials. There's a tutorial just on looking at financial shares, analyzing financial shares, especially the insurance companies. The PEG ratio and these things don't really apply to them. We use what they call embedded value. So great question, Eleanor. Obviously, we need to have a separate webinar on analyzing financial shares. The same thing with the resource stocks. You know, different ways of looking at these companies. Okay, let me see questions. There's another question from JP. JP, great questions coming through. If the P is high, can an average expect a pullback in price? Yeah. So obviously the average of the market is 18.5. You find that some sectors, especially like the general retailers, have had a good run. The average PE is much higher. Hence, those stocks are not very cheap right now. So you'll find that there will be some profit taking. The market has rated those companies very highly, but there will be a de-rating soon as people take their profits. So high PE ratios is an indication of being overvalued. Yes, I was anticipating this question. Here's a question from Dirk Prinsloo. Sorry, not Dirk. He was asking me the question here about Naspers. Someone was asking me a question about Naspers, breweries, Richmond, all those companies, based on the PEG ratio, would be expensive. But as I mentioned in the presentation, obviously these companies operate within a different interest rate environment where interest rates are much lower. So it does get a bit skewed. So that's a difficult one to answer. I'll still be looking at profitability. I'll be looking at price NAV, those kind of things also. But you must understand those companies have had a good run. They're all rand edge companies. So it's a difficult one to say now, are they cheap or expensive? They're more on the expensive side. I personally won't rush out and go buy Naspers right now at these levels. But saying that, we said the same thing when it was 800 Rand a share, now it's close to 1,000 Rand. It's a difficult one to answer, but you must understand that these guys do operate in a different environment. Here's a question from Mr. Chava. How will a company be valued as being listed? That's a difficult one in the sense that it hasn't got any historical data. You'll have to have some price earnings history so you can calculate a PE ratio and things like that. It's a difficult one. Exactly what you're saying now in your question. Difficult one, new listings. You just have to, it's more speculation, and hopefully that the companies will grow from listing. Here's another question here. Yeah, it's a good point here. On our research page, we have a recommendation page. Yeah, that's a nice starting point. Go look at our top 10 large caps, top 10 small caps, our top 10 undervalued. Go look at that list as a starting point. You can always click on the share code and take you through to the share info page, so you can see what kind of company we would highlight. But that's a good point there, is look at our recommendations. There's a question from Hans. Don't start trading. Pros and cons of trading these out of our recommendations. Obviously, you have to look at when those recommendations were put out compared to now. They might be a bit older. But again, I suggest is look at the using the search function and things like that to look at. If you want to do your own homework. It takes a bit of a while to build up a portfolio, Hans. Here's another question here from Eleanor. How important is the return on capital, ROC? We prefer to look at the return on equity. Remember, I'm an equity investor. I want to see what my return is on my funds. So, yeah, combine the two together, but I prefer the return on equity calculation. Cash flow to price. Cash flow to price. Yeah, I prefer rather to use cash flow to earnings. So yeah, Marcel, he's got a long question here. Sure. I'll have to come answer that as a private email. That's a long question regarding more dissertation. A question here from Headley. Hedley's asking the question here. He says, how do you measure what board they would do? What board said they would do to what actually happened as fundamentals look in the rearview mirror? Yeah, it's an important question. You'll see on the Value Investor, there's one comment there, one column. It says company expectations or something like that. And if the company was optimistic about meeting future earnings, it'd be positive. If they're worried about not meeting future earnings forecasts, those are companies that your red flag should be waving. So that's where you can have that bit of a connection. There's a question from Alfred, more about a complete course. We are looking at that maybe for next year, online trading, but I'll answer your question in more detail. Okay. Sure, there are questions coming through, guys. I appreciate it. If I didn't answer your questions, and once again, I apologize for the sound quality. I have an idea why it would be like that, and I've got no idea how to fix it up. But hopefully the recording will be fine. Just from my side, lastly, any questions you guys have, please send it through to me. You're welcome to phone me. There's my direct phone number. I prefer to have emails. I can do some research. But from my side, good luck, happy trading, and until next time, all the best. Thank you very much.